Hi guys, Michel here with Michel Real Estate, and in this video we'll handle the 5 biggest investment mistakes. These mistakes are some that I have made in my investment career, but others I've seen other people make on the real estate market. So whether you're buying your first property or you have actually bought multiple units and you've started to hit a wall, in this video we'll handle some of the issues and mistakes that investors make. So without further ado, let's get right into it. Now, the absolute biggest mistake that you can make is not doing a proper research. You'll be thinking like, yeah, well, Michel, I know I have to research the market. I know I have to know about prices in a certain neighborhood. Sure, I get it. You think that you know it all, but you can never know it all at all times. Sometimes it is best to make sure that you get the information, not just from your computer sitting around and trying to research some data. No, you need to actually get out there and look at properties and neighborhoods and talk to people. Not just agents, they might be helpful, but you should also knock on doors. Hey, I'm thinking about buying the property next door. I just wondered if you have been living here for a while and if you could tell me a bit about this street or about your neighborhood. And that's how you get first-hand information about the market. Now, you might figure out certain things that you would have never noticed doing just market research, sitting on your couch, looking on your phone or on your laptop. So guys, get out there, do your research, do your due diligence, and then make that investment. Next up is going too deep into debt. Debt to me is detrimental. Try to avoid as much debt as you possibly can. If you're making your first purchase and you need a house for yourself, which is also considered an investment, I get it that maybe for the first one around, you need to put debt on your own personal name. But going forward, try to avoid debt as much as possible. The reason being that when the markets are moving fast and banks are giving loans to pretty much anyone with a heartbeat, you could get a good loan at that time. But when the market flips and the interest rates start to pick up and go towards the double digits, worst case scenario for you. So try to avoid that at all costs and put in as much as you can of your own money in order to not be over leveraged. I have seen this countless times that the moment the market flips, those properties that had those great loan conditions attached to them all of a sudden become death traps to their investors. Try to avoid debt as much as you can. And then comes the issue with neglecting the cash flow and putting your money on appreciation. This is an issue that we actually have seen here in Luxembourg, where the appreciation was so amazing that people did not care anymore about the cash flow, right? So you could buy a property and a year later it would have appreciated 10%. Going on 2-3 years, your appreciation rate was through the roof. You didn't even have to collect rent. You could, but you didn't need to. And that, my friends, is not a good strategy. Appreciation happens when the market is moving fast, when a lot of people are trying to get into a market, there's steady job growth, very, very little unemployment. All those conditions can lead to a real estate market that appreciates and accumulates value too fast. What happens when it goes down? And you have not been looking at your cash flow. The issue then becomes yours, because the market does not care anymore about the value that you thought you had in the property. And if you had a loan which now has nothing to do anymore with market value, you are in deep boo-boo, my friend. Don't try to get caught up in this mistake. Cash flow is the cornerstone of investing in real estate. No cash flow, no investing. Great appreciation? Great. You can bank money while you wait and collect rent. But don't put your money on one single horse, and that horse being appreciation. Look at the cash flow, make sure that you get paid every month and that the bank does not pocket all the cash flow that you are trying to get in. Appreciation is a bonus. It's not the end game. Now, this is my absolute favorite because it all comes down to this simple, crucial mistake that we've all made as investors. Not thinking about your exit strategy. When we try to get into investing, all we think about is how can I get into it and how can I make money, right? That's great. But at some point, you will have to cash out in order to grow your portfolio. You have to move on at some point. And in order to move on, you need to liquidate. Liquidating means taxes. And taxes will come no matter what. But there's different ways of exiting. But it all depends on how you got in. If you bought a property on your own personal name, then you will be taxed personally on the capital gains that you made on that property. Have you bought it through a company or holding company, the tax game changes completely. Now we are looking at a taxation on that company, not on your gains. And governments, in general, tend to tax individuals way heavier than they do companies. So, get a clear understanding of what kind of exit strategies you could involve into the deal in order to avoid paying too much taxes and therefore hurting your future income in the investments that you will make down the line. More money in pocket, less money to the taxes, more options down the road. Exit strategy comes first, then comes the rest of your research of the investment property that you're looking at. Exit, exit, exit should be your motto. And last but not least is looking at an investment and thinking this is passive income. There's no such thing, my friends. Absolutely not possible, especially when you're looking at real estate. You will have management costs, no doubt. There will also be maintenance costs. There's no way that you can get into the property as an investor and think that 5 years down the line, you will just simply sell it for more money. That doesn't happen. You need to maintain and update your units regularly, and therefore you have to take away from your cash flow a percentage to use to do those repairs and keep maintenance. There is no such thing as passive income. I have to repeat this. This is a guru sentence. Sure, I know that in certain tax laws it is implicated as an existing income, but there's no such thing. You will always have to do something for that money. Whether you are looking into stocks or into real estate, you have to look at those stocks and make sure that your investment doesn't lose money either. It doesn't just go by itself. There's no such thing as being passive when it comes to investing. It maybe is a lot less hands-on than a job, but of course, it does not mean that it is completely unsupervised. Just sit back, let it grow, let the cash flow. This is easy, easy money. No such thing. So, these were the 5 biggest investor mistakes when it comes to real estate investments. I hope you enjoyed this video. If you did, don't forget to like, subscribe, and hit that little bell button. My name is Michel with Michel Real Estate, and hopefully I'll see you in the next video.